My name is Isabel DeMola, and I am a certified financial planner. We help our clients integrate financial planning concepts into the mortgage process. We help you build and protect your wealth by better managing your home equity and personal cash flow. We will work together with your financial planner to help you meet your long and short-term financial goals. Do you have a Type A mortgage personality or Type B? Let's take a quick look at where these personalities came from. Back in the Great Depression, a common clause in the loan agreement gave banks the right to demand full repayment of the loan at any time. When the stock market crashed, millions of investors lost huge sums of money on margin. It didn't take long for banks to run out of cash and start calling loans due. Ultimately, the Great Depression saw the stock market fall more than 75% from its 1929 highs. More than half of the nation's banks failed, and millions of homeowners unable to raise the cash they needed to pay off their loans lost their homes. And this is where we learned to never have a mortgage, to own your home outright. Since then, the rules of money have changed, and the bank can no longer call in the loan as long as you pay it on time. The government has also made mortgage interest tax deductible, so having a mortgage is actually a good thing. Let's take a look at Brother A and Brother B. Each brother is earning $150,000. They each have $100,000 in savings, and they are both going to purchase a $500,000 home. Brother A believes the old way: pay off the mortgage as soon as possible. Brother A takes out a 15-year mortgage at 5.875. He puts down $100,000, which is a 20% down payment. He has zero left to invest. His monthly payment is $3,348. He is in the 33% tax bracket. 57% of it is tax deductible. His net payment after taxes is $2,983. He sends in $200 extra each month with his mortgage payment in an effort to pay the mortgage off sooner. Brother B has a 30-year interest-only loan at 6.375%. $25,000 is his down payment, which is only 5%. He has $75,000 to invest. $2,523 is his monthly payment. 100% of it is tax deductible. $1,690 a month is his net cost after tax. Remember, they're both in the 33% tax bracket. He takes the $200 a month. Instead of sending it to the bank, he takes that and he sends it to his investment, plus $1,293 that he saved from having a lower mortgage payment, earning 6%. They both have the exact same cash flow. Brother A writes a check to the bank, and Brother B writes two checks, one to the bank and the other to his financial advisor. Who made the right decision? Let's take a look after 5 years. Brother A received $33,796 in tax savings. He has nothing left to invest. It's all going to pay off the mortgage early. Brother B received $49,955 in tax savings. He has a higher mortgage. He has roughly $205,000 in savings and investments. What would happen if both brothers suddenly lose their job? Brother A has no savings to get through the crisis. He can't get a loan, even though he has $185,562 in home equity because he has no job. He must sell his home or face foreclosure because he can't make payments. At this point, he must sell quickly, possibly at a discount. Then he might even have to pay real estate commissions, possibly up to 6 to 7%. Brother B has $205,000 to tide him over. He doesn't need a loan. He can easily make his mortgage payments even if he's unemployed for years. He has no reason to panic since he's still in control. Remember, cash is king. Let's take a look at what happens in 15 years. Brother A receives $60,500 in savings. He has $51,800 in his savings and investments, and he owns his home outright. This is a great plan. He paid off his mortgage, and he is now going to contribute the rest of his money into his savings. Let's take a look at Brother B. He received almost $150,000 in tax savings because he has a higher mortgage. He has almost $620,000 in his savings and investments. He has enough savings to pay off $475,000 mortgage and still have $143,000 left over. After 30 years, Brother A received $60,000 in tax savings. This will not increase because he paid the mortgage off and he has no more write-off. He has over $1 million in savings and investments, and he owns his home outright. This is what we were all taught to do, and it's not a bad plan. But Brother B received almost $300,000 in tax savings. He has almost $2 million in his savings and investments. He never plans to pay his home off. He enjoys the liquidity, safety, tax savings, and investment returns too much. This is actually a very conservative example. The fact is that real estate has doubled in value every 10 years, except in the 80s it went up 82%. So we would have advised Brother B to refinance and take the equity out of his house and invest, so he would have much more than $2 million. You can start using your mortgage to work for you and help you build your financial future. Give me a call at 516-317-8146 and I will show you how to have your mortgage begin working for you instead of you working for it.